Now, here is Ticky Fullerton on Your Money.
Hello there, I'm Ticky Fullerton, every night bringing you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. Coming up, the ACCC has released its digital platforms inquiry, the watchdog calling for a crackdown on tech giants and Facebook and Google, given their substantial market power. My one-on-one with ACCC Chairman Rod Sims just coming up. A torrid couple of days for IOOF, with the CEO and Chairman both stepping down today after APRA last week alleged that the pair failed to act in the shareholders' best interest. And how will shareholders react at the Westpac, NAB and ANZ AGMs? Australian Shareholders Association Chief Executive Judith Fox will join me later on in the programme as well. Well, first up, the ACCC is calling for a new watchdog to rein in the overwhelming advertising power of tech giants Google and Facebook, saying their strong market position justifies greater regulatory oversight. The ACCC's long-awaited report into the global tech giants, the first of its kind globally, has slammed their power and lack of transparency. It outlines concerns about the ability of Australian media companies to monetize their content and the extent to which customers' data is collected and used to enable target advertising. Well, ACCC Chair Rod Sims says it matters because news and journalism play a critical role in society. The ACCC is seeking feedback on its preliminary recommendations and the 8 proposed areas for further analysis and assessment, in addition to digital platforms ombudsman to investigate complaints. They include the proposed badging by digital platforms of media content produced by an accountable media business, options to fund the production of news and journalism, such as tax deductions or subsidies, and a proposal for digital platforms to allow consumers to opt out of targeted advertising. Well, for more on all of this, I'm very pleased to welcome Rod Sims, ACCC Chairman, who joins me now live from our studio in Sydney. Rod Sims, thank you so much for being there. We've obviously been waiting a long time for the report. You agree, though, that traditional media has a case, does it?
Oh, I think it does, Ticky, and look, we've done a lot of work on this report. We hope that it lays down a base of facts that people can engage with. And as you mentioned, we've put some preliminary recommendations, ideas out there, so we can engage with people to come up with recommendations in 6 months' time that really address the issues. So has taken a while, Ticky, but hopefully the people think the effort has been worth it.
Well, I say it's taken a while, but I mean, on the other hand, in order to get to the regulator to get its head around this, it's the most enormous body of work, I would imagine, and it is the first time it's really been tackled, isn't it, worldwide?
Oh, it's the first time all this information's been brought together, Ticky, and the crucial thing is it's looking at the impact on the media, the impact on advertisers, and the impact on consumers, particularly through use of their data and privacy. And you just can't look at this thing in one bit without looking at the other bits. It all hangs together. So bringing those 3 different lenses, and we've got big chapters on each, is just so fundamentally important.
In terms of potential misuse of market power, I guess that's what this data throws up. Is there evidence of misuse of market power by the tech giants, Facebook, Google?
Well, if I could put it this way, Ticky, we're trying to do, we're going down 3 paths with this report. One is to provide information so that everyone can be better informed, having used our information gathering powers. Secondly, we're going to be making recommendations to government, and those recommendations largely flow from concerns about the use of market power, or more generally what's going on here. And thirdly, once you talk misuse of market power, and I'm sorry to be technical, that's when you potentially come into breaches of the Act. But we're looking to provide transparency. We're looking to make recommendations to government so they can do things, but we've also got 5 investigations underway to see whether there have been breaches of our Act.
Now, key to this would be introducing some sort of new watchdog. I know News Corporation, you know, who I partly am owned by, recommended an algorithm review board. You say that you're not suggesting things go that far. Is that right?
Well, we're walking down a parallel path, I think, Ticky. The algorithm review board would have just let it all hang out for all to see, and the worry with that is you may get gaming of the algorithms even more than you do now. What we've suggested instead is let's have a regulator, could be an existing player or a new regulator, that looks at both the inputs into and the outputs from the algorithms and allows us to see, allows everyone to see just what's going on firstly in the ad market. Are people getting what they pay for? Are Facebook and Google favouring their own businesses? And also in the news media market, how are people getting their news? Is it being influenced in some way? Are things being ranked in ways that make it very difficult for journalism to exist? Just providing transparency. So the regulator will just be reporting regularly to let people know what's going on in ways that you just can't see now. We can see a shot at it because we've got our information gathering powers, but you'd like to be looking at this on a continuing basis and then potentially, if they see problems, making recommendations to governments.
But you see this sort of lifting the veil, if you will, and creating transparency here as really helping the market right itself a little. I mean, you talk about the importance of news, but the frustration from the traditional content makers has been that the value of their news, which is another point you make, actually it very often gets taken, the returns from it, if you like, are more in the camp of the big tech companies than they are of the original content makers.
That's right. I mean, you do have the irony where it's just possible that Google and Facebook are benefiting more from the content created by the media companies, and the media companies are themselves. So you're right, there's great problems monetizing data. There's problems partly because the way the platforms work is, and their desire to keep you on their platform, they're in a sense breaking the link between what you see and who produced what you see.
Exactly.
And so that makes it very difficult for news agencies, news companies to be able to brand their product effectively and monetize it.
Yeah.
Also,
but do you think that, I was going to say, sorry to interrupt, but do you think that, that creating the transparency will allow the market to right itself, or do you think you're going to have to be more prescriptive as a regulator?
That's what we're coming at it on both fronts, Ticky. We want to get more transparency so that governments and the community, much more importantly the community, has an eye on this on a continuing basis. But also we are looking at how more can be done to perhaps assist media companies and help consumers get better news. I mean, we make the point that journalism is a public good, and I mean that in the sense that when you and your colleagues produce stories, I can benefit from those stories even if I haven't seen them or I haven't paid you for them, because journalism helps hold people to account. It's a crucial part. I mean, it's known as the fourth estate. It's a crucial part of a well-functioning society, but it does more good than can earn money for it. So we're just trying to make sure we think through, are we under-providing and journalism, and is the role of the digital platforms making that worse and really causing a loss of something that we as a society should and I think do value.
Right. So once we have this consultation period, recommendations to government, perhaps government then acts on this. How can, given the sort of global level that these big tech companies and indeed traditional media operates at, how can Australia going it alone really make a difference? And then the next question is, what is in particular the US market looking at, given America owns these, this is where these big tech companies come from?
Oh, look, firstly, Ticky, there's certainly things Australia can do on its own. setting up a regulator. I mean, these companies are carrying on business in Australia. They can be regulated by the Australian Parliament, and they're subject to our laws. So there's plenty that can be done. We shouldn't underestimate that at all. Secondly, though, and correctly as you say, we will be engaging with our international competition counterparts to look at what globally needs to be done. And we engage with our counterparts all the time. There's about 110 of them. Every country of Europe has a competition regulator. The EC itself is a competition regulator. The Department of Justice, the Fair Trade Commission in the US. We'll be engaging with all of those. Yes. And certainly from discussions we've been having, everybody is interested. So we won't lack an audience, we won't lack people to talk to, Ticky.
Yeah, finally, privacy, such an important issue, and you say being both a competition and a consumer regulator puts you in a rather unique position. That presumably is something that can be changed quite quickly in terms of opting in or opting out.
Yeah, that's right, Ticky, and indeed we're faced with a general problem here. I mean, it just so happens that Google and Facebook, their whole business model is collecting data about you and using it in various ways to monetize it. So that's their business model, and so that raises this issue up. But I think in our look at their policies and their procedures, we would strongly argue that consumers are under-informed about what data is being collected about them and over-promised in terms of what consumers can actually do to control the use of their data. Trying to control the use of your data when you go into these platforms is way more difficult than it looks, and ultimately things you think you can control, you can't. And that worries Australian consumers.
Indeed. Rod Sims, is a huge report in a huge year for the regulators, so thanks very much for sharing it with us. Thanks.
Thanks, Ticky.
All right, after the break, we'll get some more analysis on that announcement by ACCC Chairman Rod Sims with the Australian's Media Diary writer Stephen Brooke and Your Money Chief Business reporter Leah Shanahan.
You're watching Ticky on Your Money. Now, back to Ticky.
Welcome back. We just heard from ACCC Chair Rod Sims on the Watchdog's preliminary report into the big tech companies and their impact on digital advertising. Let's get some analysis off the back of that. The Australian's Media Diary writer Stephen Brooke joins me now at the desk along with Your Money Chief Business reporter Leo Shanahan. Fellas, very interesting. He's been out and about, Rod Sims. Perhaps Leo first, what's your reaction to this report?
Well, there's a lot to it, isn't there?
There's a lot to it.
I mean, it's almost 500 pages or something, and I mean, just the depth, the scope of the challenge. I think the ACCC has to be a little careful in recommendations of the never never. You know, these ideas, oh, we'll have a regulator, we'll have an ombudsman, we'll work all this stuff out, and I'm just a bit sceptical about the timelines they're talking about here, because you have to clear this somehow with the companies, you have to clear it with government. The thing that stuck out to me, though, on the regulation front is, do you really think Google and Facebook are going to hand over their algorithms like that? I mean, you can make it the law, and that you're going to be in a very interesting situation, I think, in Australia. As you said, you know, if Australia goes it alone, how are they going to manage that?
But this is the absolute heart of it, isn't it? Because the algorithms control everything. They control search, they control what content's where, they control, you know, all sorts of things.
And also, once they've got the privacy data on you, where certain things show up. So yes, the algorithms are at the heart of both those issues, both the challenge to media and the privacy issue. So,
Stephen, really interested in your views, because you cover, obviously, the media as well, and there's been intense lobbying. When this first started, we all thought, well, who's Rod Sims going to actually listen to? Who will he take seriously? Will he actually come down on the side of traditional media?
Yes. In the short answer, he's had a real crack here. He said that these tech giants, their business practices are opaque. We don't understand how they operate, and because of that, we don't understand the algorithms. We cannot tell if they are being favourable to their business partners. We cannot tell how they are deciding what journalism to put at the top of their rankings versus the journalism that falls by the wayside. And because we simply don't know and we're unable to find out, we cannot tell whether it's undeniable they have a lot of market power in these areas, but it's undeniable to know how they are using that market power.
So when I asked Rod Sims if there's more transparency and we get to understand a little bit more of how this works, will the market then start sorting it out in terms of where the ad dollars go to? I didn't quite land the answer there, but what do you think? Do you
Well,
think
he doesn't know. I think he is saying if we have that data, then maybe the market will correct. There's been a lot of fuss amongst the media companies already over Facebook, you might remember, where Facebook changed the way that it determined its sort of rankings, and suddenly all these media platforms, Mamma Mia, etc., fell off Facebook because they decided friends and family was more important, which really destroyed some people's business models and numbers crashed. I think that Sims is saying if we know a bit more about it, then maybe the market will correct, or intervention in the form of this super regulator might need to be implemented. And that might sound great initially, but then if you have traditional media companies regulated in the same way that Google and Facebook are regulated and one size fits all, that might lead to a whole new set of problems.
Yeah, right. Leo, what do you think of the whole privacy issue?
Well, look, I think it's interesting in terms of ombudsman. I mean, that makes a lot of sense, and this notion that you have to opt in for these details to be kept, which, you know, seems pretty logical. And a lot of people would be quite worried that that's not already the way. And I think a function of this, if nothing else, is going to be an education of people about, geez, you know, they've got all this information on me already. But just some of the numbers coming out of this report was stunning. I mean, it's about $70 for every $100 spent on digital advertising in this country is between Google and Facebook, leaving $30 for the rest of the entire market to squabble over. I mean, it's just really, really incredible.
How do you think Google and Facebook will come back soon?
Well, it's interesting, isn't it? Do they try and fight this? They are in a bad position because of all the scandals that have happened, Cambridge Analytica.
Well, the whole fake news thing, it's become...
Fake news, they've got a lot on their plate globally. Here we have little old Australia, which is, you know, a backwater as far as they are concerned, but with a world-first inquiry that could influence the big regulators across Europe and the States. I think that if they want to keep their algorithms secret, they're going to have to fight for that. And in a regulatory sense, they have very few friends in their corner.
It's interesting, in Europe they've talked about a Google News tax effectively, and Rod Sims made this point very well, that actually despite, it could actually be the search engines who are making more money off news than media at the moment. And so what you've got is the idea of a tax in the EU that every time Google a story goes through Google News, Google have to pay, in effect, for some of that. He didn't buy into that today, but they're talking about that very seriously in the EU. And Google's saying, well, we could pull out of Google News in the UK.
And it's complicated even further, I think, by some of the deals that traditional media has been making with the likes of Google. I think Fairfax did a deal, didn't they, with Google as far as content was concerned?
Well, that was an advertising deal because, of course, the other side, apart from news, is the advertising spend, and these platforms promise advertisers that we can target, we can find precisely the consumer you need to get to and serve that up. And that sort of data is very attractive to media companies, which traditionally, at least in print, you've put an ad there.
But it's not 40 pieces of silver, because that was sort of how it was portrayed, wasn't it?
Well, it is a, you know, there are some people feel they have to come to an accommodation with these tech giants to get the access, because let's not forget that both in the advertising side and the media side, these platforms are brilliant conduits and have massive audiences because we're on them all the time. And
just finally, it was really interesting today, he revealed that 5 ongoing investigations as a result of the research they did into this report. That could be a very good backdoor for them to actually just demand a lot of this information from the company, saying, well, like any other, like a bank, like any other company, we want the detail and the data as to how you've done this as part of our investigation. It could be a good way for the ACCC just to access that.
That's a very good point. And finally, on the international side, I asked Rod Sims about the US. He talked about the coordination. Of course, the other bit of FANG that we don't talk about in that context is the Chinese equivalence. And they, particularly in this region, also control a lot of data and media.
Yeah, and are doing big deals with the government in the middle of it. Yeah. I mean, we think we've got a problem. I mean, what about Alibaba?
Yeah.
I mean, these guys are talk about doing, deals with government.
Yeah. So look, I think it's a great step forward, but we'll see what happens after the consultation period. Thanks, guys, very much.
Thanks, Ian.
Now, in all the CEOs we've spoken with this year, I'm not sure anyone has a work schedule quite like Sanjeev Gupta's. From what I've seen, it's in overdrive 24/7. Sure, the Royal Commission has created chaos in work schedules of big bankers, but this guy seems to be on a global mission to create a steel empire driven by alternative energy, so-called green steel. For those catching up, Sanjeev Gupta, British businessman, came to fame for buying teetering steel mills like the one at Port Talbot in Wales, saving jobs and turning around businesses. Just over a year ago, he bought the Whyalla mill in South Australia out of administration and brought his young family out to Australia for a couple of years to base himself here during the turnaround. When we interviewed him in Sydney last month, he hinted about a big announcement, and today, well, he was back in Whyalla with no less than the Prime Minister, Labor leader Bill Shorten, and the South Australian Premier Stephen Marshall. The most exciting time in Whyalla history, folk were saying. Sanjeev Gupta announced a $600 million upgrade to the Whyalla project, which he says will drive an increase in steel production from 1 million to 1.8 million tonnes in 3 years. And at a time when our relations with China are, well, shall we say, a little tense, particularly when it comes to investment, it's a little ironic that it's taken a British businessman with Indian roots to pull some significant Chinese investment, not just into the green steel project of Whyalla, but also more broadly into the Whyalla community. Sky News South Australian reporter Stacey Lee travelled up to Whyalla to cover the day.
Christmas has come early for the people of Whyalla after Sanjeev Gupta unveiled his big plans for the steel-making city. Internationally, he's been dubbed the Man of Steel, and Mr Gupta is no doubt hoping that today's announcement will cement him that title here in Australia as well. He announced a $600 million upgrade of the steel mill to increase production to 1.8 million tonnes, as well as a feasibility study that will be undertaken to potentially build another steel plant with a capacity of 10 million tonnes. That would be one of the biggest in the world.
Australia needs a state-of-the-art section rail mill. It's a country which still has to be a lot of building to do to be able to provide the steel for that and to be able to provide rail for our railways, which are continuing to grow.
There's also more than $200 million being invested privately to build up the local community. That includes a new foreshore hotel and tourist hub, as well as a recycling plant. The Prime Minister, Opposition Leader and State Premier were here for the announcement and welcomed the massive investments.
We've got $50 million that we're going to put towards the transformation, $100 million going into a brand new school, and also $200 million going into statewide upgrade of traineeships and apprenticeships.
It is the comeback city in the turnaround state, and we look forward to that being realised in the months and the years and the decades ahead.
It's expected that thousands of jobs will be created during the construction phase, but it's hoped many of those will be ongoing as well. The local council is expecting a population boom from the current number of 22,000 to around 80,000 over the next 10 years. Stacey Lee, Sky News in Whyalla.
Yeah, now, that's a really big story because the British press are talking about the leverage that Sanjeev Gupta is going, the pace of his growth, and can he keep it up? He's also talking about floating parts of his business, so it'll be a big story through next year. Anyway, Australia's first new Joint Strike Fighters, 2 of them, have touched down at their RAAF base near Newcastle. The F-35s will replace the F-18 Hornets and promise to transform the nation's air defence capabilities.
Touching down in Newcastle, the new sound of Australia's air superiority. Standing side by side at Williamtown Air Base, the most advanced fighter jet in history. The first 2 pilots of No. 3 Squadron touching down in Australia.
It's great. I mean, it's a very, very easy to fly, almost too easy to fly. You forget you're flying it sometimes, and as I've kind of said before, it's a computer pretending to be an aeroplane.
Australia's ordered 72 of the aircraft so far, the program costing more than $17 billion. The first 2, $120 million each. And it's been a 16-year wait. But Australia is the first country in the region to receive the futuristic fighter.
We throw the word historic around in politics pretty liberally and in general. But when the first of type or the first of class of something as significant as the largest purchase in the Air Force's history lands in Australia for the first time. That seriously is an historic day.
The planes left the Luke Air Force Base in Arizona last week, hopping their way back to Australia.
Welcome to the latest chapter of the F-35 story, the most significant Royal Australian Air Force acquisition in our 97-year history.
The F-35's stealth capability widens the operational theatre for the ADF because it can fly undetected.
Our priority is to be able to maintain our national interests, to defend our national interests, to be a good ally when called upon to do so.
The plane faced growing pains as the new technology was developed. From problems with software, weapons and engines, it's years behind schedule. But aviation experts insist the plane is a game changer.
It's a huge generational shift for the Air Force. I think the thing with this aeroplane is it kind of looks like any other fighter jet to anyone who's uninitiated, but the secret is really, and it has the stealth, low observables, hard to detect on radar, and it has very sophisticated sensors of its own, and it's very sophisticated at how it shares information that it collects from its sensors with other aircraft. So it's definitely a game changer.
The F-35 is the fifth-generation fighter jet and becomes the heart and soul of the Australian Defence Force. More than 50 local manufacturers have helped to build the fighter jet.
Australia and the United States have long been united by shared beliefs in human dignity, in human equality, and in opportunities for all.
The first two aircraft will join No. 3 Squadron to replace the F-18s over the coming years. Aaron Young, Sky News at the RAF Williamtown Base in Newcastle.
After the break, a torrid couple of days for IOOF. We'll get an analyst perspective. My interview with Chanaka Gunasekera coming up from Morningstar.
This is Ticky on Your Money, covering the big business stories.
Welcome back. Well, the carnage in the wake of the Royal Commission continues, with both Managing Director and Chairman of IOOF stepping down. Last week, APRA launched proceedings against the company and the management, accusing them of failing customers and failing to act fast enough to remedy the situation. Renato Motak, the currently Group GM Wealth Management, is now acting CEO, replacing Christopher Kelleher, and Alan Griffiths, a current non-executive director of IFL, has been appointed acting chair, replacing George Vernardis. The acting chair says IOOF maintains the allegations made by APRA are, quote, misconceived and will be vigorously defended. He says the MD and chair are stepping aside for now in the interests of good governance. Well, it's been a horror couple of days for the financial institution, plunging around 40% since the APRA announcement on Friday. Well, for some analysis on the plagued IOOF, I spoke with Morningstar and analyst Chanaka Gunasekera a little earlier. Chanaka Gunasekera, will look very shocking news for any investors in IOOF. How much has the share price and value plunged in the last couple of days?
Yeah, I think a lot of it's got to do with the uncertainty, and also, I mean, it was really an unprecedented action by APRA to attempt to try and disqualify 5 key persons of an ASX listed company. So. And then on top of that, you got the ANZ acquisition and the reputational damage and how that's going to affect fund flows. So hopefully the company will provide a bit more details on things like the ANZ acquisition in particular.
Right. Well, you've got the top 2 business leaders stepping down, being forced to stand down, regardless of the outcome. Even if they win their cases that they're planning to fight, they're not coming back, surely.
Yeah, I'd be surprised. I mean, given the APRA allegations, I mean, obviously, your relationship with your key regulator, APRA and also ASIC, is one of the key elements of good corporate governance, and it's clear from the APRA allegations that they just haven't done that. So, yeah, I think it'd be hard for me to see them to come back, even if they're not disqualified.
Yeah, if they are disqualified, what further inflictions will this deliver on IOOF? Because presumably the other 3 members of the management team will also be, their positions will be under threat too, wouldn't they?
I would suspect so, yeah. I think, obviously, with the key, 5 of the key management team leaving, your strategy going forward is up in the air, and then the reputational damage also. I mean, the key thing for these organisations like IOOF and AMPs, you need to attract advisors, and you need to attract investors and fund flows is a key driver of performance, and so that's going to be a key issue. Before the issues with AMP in April, they've had a 7 times a fall in fund flows from from the issues they had in April to the most recent quarter results. So you could expect something like that with potential with IOOF as well.
And as I was saying yesterday, unlike the big banks, who are obviously also being hammered by the Royal Commission fallout, they can at least fall back onto the business of banking, whereas AMP and IOOF can't.
Yeah, and the other thing I think is also important is that the banks are systemically important organisations, whereas organisations like particularly IOOF probably isn't. So I suspect the regulators can go a little bit harder with organisations like IOOF and also AMP. So that is it's a risk going forward as well.
Chanaka, what do we know about the sale of ANZ's wealth business to IOOF, because that was a big deal. How far has it got to, and what are the chances that it won't go through?
Well, they completed 80% of the deal on the 1st of October this year. They've moved over the aligned dealer group, and about 600 to 700 financial advisors now moved over to IOOF. So what was left was the successor fund transfer. Now, the successor fund transfer is a key growth element of the acquisition. And so they've paid $800 million already, but that was to acquire a debt note, and because they haven't received the successor fund transfer, they're receiving about 14% coupon on the debt note. Mm-hmm. So now I suspect there's a strong likelihood that the trustee of the ANZ super funds will decide that this is not in the members' best interest and may block this deal going forward. So the successor fund transfer might stop, which is an issue because that's the key element of earnings growth, near-term earnings growth for IOOF.
Right, and meanwhile they've got how many people do you say was part of the aligned dealer group? I think it was between 600 and 700. I think it was 660.
Now,
are they going to would they stay with IOOF?
I think that. That's probably the most likely, because the aligned dealer group part of the transaction is complete. So, yes. But that's the least profitable part of the transaction. So,
yeah. You'd wonder what those dealers actually feel about that.
Absolutely. I mean, we don't know that yet, but yeah, that's certainly an issue as well.
If you were an investor in IOOF, what would your strategy be going forward? How would you see this playing out?
Yeah, look, I think there's likely to be management change. There's also probably going to likely be class actions against them. I suspect ASIC might also look into these guys as well, because although the 5th round of hearings focused on superannuation, there were some issues around FOFA, whether they breached FOFA legislation. So there's a potential.
There were certainly murmurs around that already, but I mean, down 40% this stock in 2 days. Yeah. At some stage, is there some value there, and is there an opportunity to actually come in?
Yeah, there could be. The issue for me is that debt note, because they've already paid $800 million. Now, I suspect that they will recoup a lot of that back, plus interest. So I've been sort of trying to confirm with the company, the terms of that debt note if the ANZ acquisition doesn't go through. Now, if that comes back, then they're probably going to have net cash around about $400 million. Now, they're going to have to retain a fair amount of net cash because of the issues, the headwinds going forward. So there is I suspect, obviously a price to buy this. The balance sheet, as of 30th of June 2018, had a net cash position of about $500 million. Now, there was restricted cash about a bit over $100 million, but since then they've bought the ANZ acquisition, which cost them $800. So I suspect they haven't disclosed this, but my guess is they're in sort of a net debt of around about 400 million. And if they get the 800 million back from the debt note they bought, then I think they're in the balance sheets may be in a reasonable position, but we really need more information about, you know, the terms of that debt note.
Well, thank you for giving us information that is available to the market. That's very interesting, but a bit of a scrambled egg though, isn't it?
It is, yeah.
All right. Chanaka Gunasekera, thank you so much for joining us.
No worries.
Well, if you read the newspapers, it's been a pretty dismal year for IPOs in 2018, with the two largest floats, Coronado Coal and Viva Energy, both falling between 20 and 25% since listing. So what can we expect next year? Well, let's get a recap for the year first of all, and then a look ahead with OnMarket CEO Ben Bucknell, who joins me live at the desk. Are the papers right, Ben? Has it been a dismal year for IPOs?
Well, it's a tricky one, Ticky. So if you pull out a couple of the figures of the worst performing big IPOs, it looks terrible. But what's interesting is if you look at the actual average performances of all the IPOs through the year, and so you say, for example, I put money into every IPO, the same amount into every IPO and sold out. A month later, after the listing, you would have made 42% on your money.
So if you stagger it, you make 42%?
Well, if it's a month out, yeah. Otherwise, the trouble is you get caught up with the market momentum, you see. So you've got the banks down sort of circa 20%. You've got Telstra down 17%. Origin Energy down 24%. Even the Small Ords is down 8.8%. So it's important to remember.
But is it the big end of town, sort of the big companies that have done not so well and the little companies that have done better?
Well, I think certainly the big IPOs have struggled this year, and we've seen a couple pulled, like Latitude, which everybody knows about, and there's been a few pulled towards the end of the year. But IPOs are priced against the market, so it depends how the market's doing at the time that they price.
Yes. All right. What about the volumes of IPOs? Has that gone up or down this year?
Well, in terms of actual numbers, it's not that far different. So it's 85 IPOs for the year to date versus 113 2 years ago and 95 last year. But if you look at the actual numbers, it's up to 18 of amount capital raised. Then you're looking at $18 billion raised this year versus 13 last year versus 10 the year before.
So what's driven that?
Some of the big ones. So you had Viva Energy, Colorado Coal, L1, a few big licks going out there.
Are the listed investment companies?
That nobody wants to talk about.
Why? What's happened to them? You tell me.
Well, I think they're down around about 23%.
Now, what's that driven by, do you think? The property market or the...
Look, I think, I mean, they substantially increased their offer size from 500 million up to 1.3 billion. They've just lost the ratings. So I think there's a few people who are pretty annoyed about L1.
Right, investors.
Oh, yes.
So the other issue is, of course, the numbers of retail investors that can actually access some of these IPOs. That's something that I know is a bugbear of yours.
It's still a massive problem. You know, you have this market, this thing called an initial public offering. It's not offered to the public. They're initial institutional offerings. So we're doing about 35% of the market in terms of number of IPOs that we give to the public. But that means
there's another 35% of the market?
3 years in. So we just hit 100 deals in 1,000 days, which is, I've chosen, I had a little bit of liberty on the rounding there to make it sound better, but 100 deals in 1,000 days. So 3 years ago we had a chat after we launched the business. But to think that we don't allow public investors into IPOs as a matter of course in Australia is astonishing.
And you mean mums and dads, basically?
Mums and dads. So Hong Kong it does, Singapore.
Okay, but is there a sophisticated investor issue here that...
There is. So what happens is the IPOs are pre-sold before the prospectus is lodged. And so the retail investor, the genuine mum and dad investors, they don't have any shares left for them by the time the prospectus is lodged, and that's when they can legally go in.
But is that, I mean, you could argue that ordinary folk retail investors are going to be exposed to it through their super or anything else?
It goes against the fundamental principle of the market that everybody's treated fairly, no matter whether you're a small investor investing $2,000 or $500 as your first investment in the share market, or whether you're a great big super fund, or dare I say it, one of the retail super funds from the banks.
You're saying it's a bit sort of catch-22 because if it's all sewn up before the prospectus, as you need as a retail investor, you need to be able to rely on the prospectus, don't you, to make an investment?
That's the most extraordinary irony. So we've got this situation where the regulation says it must be drafted for a standard able to be read and understood by a retail investor.
Yes.
And yet no retail investors get in on the big ones. They actually only get offered the smaller ones. So the irony is they get locked out of the so-called less risky big ones,
yes,
and they get offered the smaller IPOs.
Well, it sounds like from what's happened this year that actually they're better off in the smaller ones.
Well, this year they have been.
Okay, and what about coming up? I mean, you're connected to a few deals. Tell us about some of these flows.
Yes, so we've got a few really interesting ones at the moment. We've got Candy Club, Candy to your door, big in the US, probably not so big
Candy
here.
to your door.
Candy to your door.
Oh, help us. It's bad enough having the pest of power at the supermarkets. Candy to your door, right. And when's that floating?
So that's open now. So they did 11 million of revenue, and they've got about 20,000, 25,000 subscribers monthly.
Yes.
Then there's another one opening tomorrow. That's Unity Wireless. So that's quite interesting because that's Mick Simmons. Now, I don't know whether you remember Mick, but he was the CEO of Soul Patts's telecommunications vehicle before it merged with TPG.
TPG. Right.
Then he went on to Vocus and M2, and so very experienced telco guy. Got an experienced team there. They're big in Adelaide and Melbourne.
And they're doing a fixed wireless broadband network and services.
It's an NBN replacement, so a lot of people will be pleased to hear about that.
Yeah, starting in South Australia.
Starting in South Australia.
All right, and the Cup Exchange.
Well, this is a fascinating one. This one's dear to my heart. This is an equity crowdfunding.
Yes.
So they're out there raising 600,000 to 1.2 million. They've hit the minimum amount of the raise.
Yes.
And what it is it's when you download an app. When you go to the cafe, you get a cup. It gets scanned out to you, and then when you can return it to any other cafe, and it'll get washed. Now, these cups, there's 2 points about this that I think are fascinating.
Yes.
Firstly, 1.2 billion cups are sent to landfill every year in Australia. So a huge wastage problem.
I agree.
So these are washed,
Yes.
but you don't have the hassle of having to carry them around with you all day and wash it yourself.
Yes.
But the economics of this are really interesting. So 1 month's subscription pays for the landed cost of a cup. Now, and for you as a consumer, you pay around about $12 a year to have the right to a clean cup, called the Cup Exchange. Interestingly, uses a material which is sort of like a glass replacement.
Yes.
Crush it down, make a new cup.
But providing you're passing coffee cups, you're drinking at one coffee place, you drink while you walk, and then you can drop it off at the next coffee place?
That's right. Or what they've got is some precincts that are saying, hey, we don't want all this wastage, so we'll wash it for you. So it closes tomorrow. Anyway, dear to my heart.
All right.
And love that one.
Very interesting. Ben Bucknell, thanks for coming in and explaining a little bit about the IPO market.
Thanks, Ticky.
When will they be able to recycle coffee cups? I do not know. After the break, how will shareholders respond at the Westpac, ANZ and NAB AGMs? Judith Fox, CEO of the Australian Shareholders Association, will join me next.
Now, back to Ticky.
Welcome back. We've got 3 very big AGMs in the next couple of weeks. Westpac on Wednesday and then NAB and ANZ both on Wednesday the following week. Collectively, we've heard that the Big Four and AMP are expected to have coughed up around $6 billion in customer refunds, internal reviews and litigation fees. So how will that translate on the AGM floor? Will we see a REM strike or 2 or 3? Well, let's find out. Joining me now at the desk is CEO of the Australian Shareholders Association, Judith Fox. Judith, great to have you here.
Thank you.
Now, I was just reading that certainly the nation's biggest superannuation fund, Ian Silk, is not very happy. He's going to vote Aussie Super against the remuneration reports of the big 3 major banks. What are you recommending that your members do?
We're not happy with NAB and Westpac and agree that not enough has been taken in regard to all the misconduct that we witnessed at the Royal Commission. ANZ, we think, has done a different job. The directors have taken a haircut, 20% reduction in director fees, whereas at NAB and Westpac, the directors didn't seem to feel that they needed to share the pain of shareholders, yet they're shareholders' agents.
Yeah, ANZ really has pitched itself very nicely, hasn't it? You know, David Gonski there and Shane Elliott as the sort of the relatively good guys through the Royal Commission as well. and also the way they negotiated away from the other three banks. This has been going on for some time now, hasn't it?
It has, and I think what we've seen constantly, and Catherine Livingstone did it too at CBA, and let's not forget they've already had their AGM and they did not get a strike against the REM report.
Well, mind you, I don't think, well, maybe I'm wrong, but I don't think Aussie Super really woke up to that fact. They suddenly decided that they were going to make a stand, but meanwhile the AGM's already happened for CBA.
No, I don't think so. I think it was that we all looked at CBA and went, OK, no KMPs got any of their short-term incentives.
Right.
There was, again, a 20% director haircut.
Yeah.
So sharing the pain, taking accountability.
Yeah. And they did hack although David Turner won't give his money back, I don't think, will he?
No, but no, that was interesting. But there was certainly a lot of executives have been given the chop and gone, whereas, again, I agree with you, ANZ has really thought through what does this look like from the shareholder and community perspective as opposed to business as usual.
So these guys at NAB and Westpac, you know, it's quite interesting. You've got Lindsay Maxted at Westpac there, Ken Henry at NAB. They'll be defending their position, so you'll be asking questions about their remuneration reports?
Absolutely. NAB, we see, has tried to deal with the sort of incredibly complex structures of remuneration frameworks, but our concern with that is that there's no real clarity as to what happens with the long term. It's all about the board discretion on forfeiture, and everything gets judged on 12 months. We need to see much more information about what does discretion mean, what actually will cause you to ask a executive to forfeit a bonus.
Didn't Ken Henry, am I right, my memory right, that he got incredibly frustrated by saying, look, you know, we've been trying to actually change things, and, you know, then sort of everyone's an expert on the floor, and it's really hard for boards to actually get sign-off to changes to their existing rules because everybody says, no, we don't like that either.
Well, I think that's true, but I also think part of your job as a board is to get sufficient numbers of shareholders to say, well, we'll have a look at it and see.
Yes.
But with NAB, sufficient numbers have said, we don't really like that idea of board discretion without seeing what the measures are.
Yes.
It's a bit too much like the old-fashioned trust us, we're directors, and I think in the current climate that doesn't really wash.
And do you think, do you agree with, for example, I've seen ACCC, the Australian Council of Superannuation Investors, they're very dark as well on the three banks, and don't see why there should be these sort of remuneration, particularly when it comes, I think, to bonuses and what's actually should be your normal job, and when a bonus is really
shooting the lights out.
Yeah.
Yeah, and I think they've made the point that, you know, if this year you're still getting a bonus, when will you ever not get a bonus?
Yes.
And the banks have sort of said, no, we're talking variable pay, but variable remuneration is in fact a bonus because it means you've done above and beyond normal performance.
Yes.
So I think this year we can say they've gone above and beyond, but not in a good way. So I think that whole idea of variable pay, which is meant to reward extraordinary performance, there are serious questions as to why.
Bonuses should be able to be clawed back, should they?
Clawed back or forfeited, and that's board discretion, and you can see that's what NAB has tried to get to. But as investors, we just can't see what the metrics are on that, so there's not enough information.
And why have you got an issue with Westpac?
Westpac, well, again, the board hasn't really shared the accountability. They haven't felt that they needed to take a financial penalty, and they're not really sort of willing to share the pain. But also, there's insufficient reduction of the short-term incentives or the bonuses being paid to executives.
And their cockiness, in a way, has paid off. I mean, the board's decision to actually, on the BBSW case and, you know, various other things, have actually, in terms of returns or amounts that they had to give back, kind of worked in their favour. Haven't they done a reasonable job at that?
Well, except this might not work in their favour. I think there's this feeling that on this one they really haven't listened sufficiently to shareholders and concern generally about we needed to see that your executives, why didn't they cut the bonuses to zero? If not this year, when?
Yeah, OK. So finally, of these three banks, do you reckon any of them are going to get a first strike?
I think there's a strong likelihood, Westpac and NAB. ANZ, I think, will be OK. I think they'll escape, like CBA. So, interesting times.
Sure are. Judith Fox, thank you very much for coming in.
Thanks.
OK, well, thousands are marching, accusing British Prime Minister Theresa May of a Brexit betrayal. With just 2 days of debating before the Parliament votes on Brexit, she's facing a huge battle to get the deal through.
This isn't just about the Tory leadership. In the rest of the country, pro- and anti-Brexit forces are amassing, preparing for the fight to come. Today alone in London, 2 rallies, one demanding Brexit is protected and another demanding another referendum. With half an eye on these movements, one government minister said today that the stakes could not be higher.
We've got to try and win the vote. I'm not going to speculate as to what happens should the deal or the final vote be voted down. I think that would create a lot more uncertainty. I think it would create chaos.
And that chaos could start first with the Conservative Party.
This is of such a fundamental character, this issue, that it may be the end of the Conservative Party in its current form. That bothers me very much.
If Theresa May does stand down and is forced out, it's easy to see how that might happen. Tory MPs would have to elect a new leader. They would whittle the number of candidates down to 2, and those 2 would be sent to the Tory party grassroots for them to make the final decision. Now, one of them would almost certainly be a Brexiter, and they could well choose to run on a hard Brexit, no-deal prospectus, which the Tory party grassroots would love. They win. Some of the Remainer Tory MPs can't live with it, and they split, and that could all flow from what is certain to happen in there. The referendum was supposed to heal the Tory civil war. Instead, it has spread the disease to the rest of us. Whether May stay or goes, whether it's May's deal, the Norway deal, no deal, people's vote will remain. The Tory party and the rest of the country will instead be living with it for a long time to come. Lewis Goodall, Sky News, Westminster.
And that's all for the show tonight. Tomorrow night we'll get expectations for the Tuesday evening Brexit vote with CEO of the Australian British Chamber of Commerce, David McCready. See you tomorrow at 4:30 p.m. Eastern Time, or tonight on Catch Up at 10 p.m. Thanks for your company.